The Fed has a decision. Here's what you need to know. There's a choice to make. Tame the fires of inflation or preserve economic growth. And unfortunately, at this point, it can't be both. You're going to see exactly what is the challenge that we now face and how this can impact financial markets. We're also going to consider when was the last time the Fed faced this particular dilemma, which path they chose at the time, and how this led to catastrophic results. Let's begin with recent manufacturing data because this all ties in. We just received three new reports, which we can summarize as saying the so-so, the bad, and the really bad. First off, the so-so, industrial production. This figure provides insight into the health of the manufacturing, mining, and utility sectors of the economy. Values greater than zero indicate growth in the manufacturing space, and below zero, they indicate decline. This week, we received a monthly update of 102.3. While this data indicates manufacturing overall is still expanding, we can see a general decline after reaching highs of 103.5 in September of 22. The downward trend is concerning because we've seen this pattern in the past. Let's travel back in time to the strong markets of '07. The S&P 500 shown here in white was chugging along at record highs while manufacturing was strong and industrial production figures experienced comparable growth. By the end of '07, industrial production began to decline from recent swing highs around 102. Within the next year, this barometer of economic growth dramatically declined to a meager 91 by December of '08. While we consider industrial production figures to be so-so, capacity utilization is a solid bad. This measure serves as a gauge of how effectively industries are using their full production capacity. Readings below zero indicate the sector is producing less than its full potential. The current month's reading of 78 ties with last month's report and represents the lowest of several years. This implies that perhaps due to lack of demand or perhaps a high interest rate environment, there is slack and inefficiency in the industry. Once again, turning our attention back in time to the latter days of '07 and '08, we can see a rather strong correlation between this manufacturing gauge and stocks. In fact, in the depths of the financial crisis of '08, capacity utilization reached depths near 70. It's important to draw this comparison as manufacturing plays such an important role in our economy, and accordingly, the downtrend is certainly troubling. You may wonder, is this weakness in manufacturing related to high interest rates? Is it concerning that inflation remains high while growth slumps? Certainly, this was not the plan. In just a moment, we're going to show you exactly where we are in that cycle, and it's concerning to say the least. While industrial production is so-so and capacity utilization is bad, the Empire Index is really bad. This illustrates the state of manufacturing within the state of New York. This month's update now puts the Empire State Manufacturing Index at a negative 21. Negative numbers indicate the business activity has dropped sharply. But what's more troubling is to the degree we now see the negative readings. Notice over the course of the past year, this monthly survey is consistently reaching depths in negative 20s and 30s, and as deep as negative 44 in January. Once again, going back in time, the stock market tracked very closely with the decline of this economic barometer. In the final 3 months of '08, the Empire State Manufacturing Index reported a negative 26, 23, and 25 respectively. Just a reminder, we're currently at a negative 21 after touching recently lows of negative 44. Very bad indeed. But now we will tell you why this poor manufacturing data is actually so relevant and the situation is even more bleak. The following chart does not give a specific number, but rather demonstrate an economic concept. Shown here in red is our current inflation rate, such as the CPI, and a gauge of growth, such as our current manufacturing data. What you'll notice is inflation is steadily trending from left to right, not really going up or down. This is essentially what's happening right now with our consumer price index. We're going to show you the actual chart in just a second. At the same time, the growth number is worsening, like our current manufacturing data. In other words, inflation is steady while the economy weakens. In plain words, we're paying the same prices, but the situation within our economy is actually getting worse. Here's an example of what this economic cycle looked like entering '08. Shown in blue, the consumer price index, inflation. In yellow, industrial production, growth, in manufacturing specifically. Notice how growth begins to decline while inflation actually rises. Here we can see the prices we paid for goods and services actually rose while the manufacturing sector declined. That decline means less jobs, lower salaries, fewer bonuses, less hiring, and overall decay in the sector. And of course, we can see what happened to the manufacturing sector shortly after, a massive drop in productivity. So where are we now? The white line shows the rate of inflation, consumer price index compared to industrial production. From September of last year through present date, notice how industrial production has deteriorated while the inflation rate remains more or less steady. It's the same patterns we saw in '07. But this weakness was not only contained in industrial production. Let's consider capacity utilization. Again, we see the same pattern, a decline in growth while inflation remains steady. While this crossover in the trend is quite subtle, and frankly, it's easy to miss it unless we're looking for it, the ramifications are quite significant. So where are we now with capacity utilization today? It's the same pattern emerging, the same steady rate of inflation while capacity of which manufacturers operate continues to decline for the past 8 months. Is this economic phenomenon contained only to manufacturing? Not at all. Here we can see what retail sales look like in the latter days of '07, specifically retail trade, a common measure of the strength of the consumer, shown in yellow, and the CPI in blue. And the same pattern emerges. Consumer demand wanes while the prices consumers pay actually rises. Of course, eventually as retail trade really starts to fall, consumer prices follow suit. After all, without the demand, the stores must lower prices to try to capture any kind of business they can. So where are we now? We can see retail sales have tracked pretty closely with the rate of inflation, but just within the past 2 months, we see significant weakness in retail sales, especially considering the consumer price index has not only not declined, but actually upticked in the last report. Where do we go from here? This week's economic calendar is quite full. Starting out with building permits and housing starts, these are key leading indicators. Of course, we have a Fed meeting followed by existing home sales and the Philly Fed Index. The Philly Fed in particular will be quite interesting as this is just one more manufacturing report following last week's data. The figure in particular that we can see is very weak for quite a long time, spending the better part of the past 2 years in negative territory. We're going to keep a special eye out to see if this pattern does continue. Not only with manufacturing numbers, but all data reports. The pattern of very sticky inflation that just does not seem to want to go down, and measures of economic growth that are decaying before our very own eyes. Speaking of sticky inflation, we recently took a close look at this very topic. If you'd like to learn more about our current state of inflation, we'll put up a link here as well. Monetary policy isn't shrouded in mystery. The Fed's mission is actually quite clear. The surge in prices has eroded our purchasing power, effectively acting as an indirect form of taxation. To counter this, the Fed raises interest rates, aiming to cool economic growth. Ideally, this chilling effect should be felt equally and gradually in all facets of the economy, growth as well as inflation. If manufacturing declines, so should producer prices. If retail sales decline, so should consumer prices. However, at the moment, the chart patterns are chilling, and not in a good way. While growth cools, inflation remains hot. While our path is unclear, we tread forward with cautious optimism, hoping for the cooling season to begin while avoiding fiery storms and catastrophic blizzards.